Listen up. When a heavyweight like JPMorgan moves, markets don't just blink, they react. Recently, JPMorgan boosted its gold price forecast to a massive $6,300 per ounce by the end of 2026. And this isn't some random Twitter headline. This comes straight from a report outlining their rationale based on structural global demand. Here's the real talk. Gold isn't being priced like a dustic relic anymore. It's being treated as a core asset in the portfolios of the world's biggest players. That's because central banks are buying gold faster than historic norms, around 800 tons expected in 2026, according to JPMorgan's analysts. Let's break this down so you understand the driving force. Central bank buying. Governments and state banks don't buy gold for fun. They do it when they're questioning the long-term value of currencies like the US dollar. Investor demand. Professional investors are shifting capital from bonds and cash into hard assets, not because it's trendy, but because it's smart hedge play against crashes, inflation, and geopolitical instability. Diversification strategy. Gold historically protects wealth when markets get messy, and right now, markets are extremely messy. When JPMorgan says $6,300, they're not whispering. They're signaling that structural forces are stacking in gold's favor. This means smart money is already moving, and those who wait might end up buying at the top, not near the bottom. That mindset, the difference between being a leader or a follower, is exactly what separates winners from everybody else.
The market backdrop. Why gold crashed, then recovered, and what JPMorgan sees next.
Now, don't get it twisted. Gold didn't just keep rising straight up. Markets are ruthless when they shift sentiment and policies. Take the recent drop. Gold plunged nearly 10% in a single session, a historic move not seen since the early 1980s. This was triggered largely by political news, the nomination of a new Federal Reserve chair signaling a hawkish stance that strengthened the dollar and scared off short-term gold bulls. But hold up, here's the truth most pundits won't tell you. Corrections are not collapses. They're natural market reactions. Think of them like seasonal breathers after a sprint. They don't erase the trend, they legitimize it over time by shaking out weak hands. JPMorgan isn't ignoring this volatility. They're staring it straight in the eye and saying, we see a continued structural trend, driven by central bank and investor demand, that still points upward. That's not optimism, that's conviction backed by research, data, and global flows. And here's the part most people miss. Markets reward conviction. Weak traders panic and sell on drops. Strong hands hold and accumulate. JPMorgan's forecast isn't hinged on a perfect world. It's built for a messy, unpredictable global economy. That means the forecast isn't built on wishful thinking. It's built for volatility. If you want to play in markets like this, you need to think multi-year, not quarter by quarter. Legacy institutions like JPMorgan aren't making short calls. They're positioning for decades. That's how you predict a rebound that hits new ceilings instead of just bouncing off the floor.
Section 3. Macro forces and safe haven demand. The real drivers nobody wants to admit.
Think gold's rally is random? Wrong. Gold doesn't move because analysts have good hair or headlines go viral. It moves on fear, uncertainty, and structural capital flows. Let's break down the concrete forces. 1. Central banks are hoarding gold. This isn't kid stuff. Countries are shifting reserves into gold, not because they're bored, but because they're hedging against currency devaluation and geopolitical risk. JPMorgan expects central banks to keep buying, a huge bullish base demand. 2. Investors are running to safety. Money is fleeing risk assets, equities, bonds, emerging markets, and pairing into gold through ETFs and bullion. According to recent data, inflows into gold ETFs and minor ETFs hit record levels as investors hunt safety. When the smart money reallocates, markets don't just rise, they structurally re-rate the asset. 3. Geopolitical stress. Whether it's tariff wars, war risk, or central bank policy uncertainty, gold thrives on geopolitical tension. That's why Zeus-level macro events shake gold harder than fear itself. People forget this. Even when prices fluctuate, the underlying demand drivers remain intact. These aren't flukes, they're fundamental structural plays that don't disappear when prices dip. Gold is no longer just a safe haven, it's becoming a core strategic asset in portfolios globally. Most traders are still stuck thinking gold is only a hedge. The institutional shift sees gold as an essential diversification and risk management tool. Agents who position early, before everyone else catches on, are the ones who win big, not ones who chase the narrative.
Section 4. The psychological impact. How this forecast should change your trading mindset.
I'm going to hit you with a truth no one talks about. Markets aren't just numbers. They're psychology plus position flows. Here's how this JPMorgan forecast should change the way you think. 1. Most people react. Leaders act. Retail players jump in after gold rallies, often right before tops. JPMorgan isn't talking about short-term hype. They're talking structural demand that plays out over years, not weeks. If you still trade news instead of reading macro shifts, you're always behind. 2. Corrections are opportunity, not death. Every major gold rally in history has had brutal pullbacks. These aren't failures. They're creators of higher lows that set up bigger highs. The sharper the correction, the stronger the subsequent trend can be, if fundamental demand remains. And in this case, fundamentals aren't just intact, they're strengthening. Gold might rust physically, but investors are polishing its price. 3. Positioning is everything. When big institutions reposition, central banks, global funds, commodity traders, retail sentiment eventually catches up. But winners are those who think months ahead, not minutes ahead. Buy and hold mentality isn't obsolete, it's strategic, especially in a world where fiat currencies are losing appeal and political risk is rising.
Wrap up. The brutal truth.
Gold isn't just going to rebound, it's being repriced by global macro dynamics. JPMorgan's forecast isn't fluff, it's rooted in demand trends that dominate the next cycle. If you're sitting around hoping gold magically rebounds, you're wasting time. But if you understand the why behind the forecast, you can anticipate flows and position accordingly. This market is not for the timid. It's for those who see beyond daily price noise and recognize where capital actually flows. You wanted forward-thinking truth? Here it is. Gold isn't just rebounding, it's being recalibrated as a strategic asset class on its own merit. If you want to speculate, speculators will lose when volatility spikes. If you want to invest structurally, this is one signal you don't ignore.